Welcome, everyone. We're kicking off 2026 with a deep dive into its first big IPO, Bharat Coking Coal Limited, or BCCL, as you'll probably hear me call it. Now, at first glance, it looks pretty straightforward, right? It's a government company, a part of the massive Coal India. But, and this is a big but, there's a real puzzle at the core of its business, something that just doesn't quite make sense.
You know, every company has its own story, but BCCL's, well, it's got a secret, a real head-scratcher. There's this paradox right at its heart that honestly seems impossible. But don't worry, in this explainer, we're going to unravel it all, piece by piece.
All right, so let's get the basics down. Who is BCCL? Well, for starters, it's a wholly owned subsidiary of Coal India. It's a government company, and it's even got this mini Ratna status, which basically means it's a pretty big deal in India's energy scene. And where do they operate? They're concentrated in two of India's most crucial coal belts. You've got the Jharia coal field in Jharkhand and the Raniganj coal field over in West Bengal.
Okay, so what do they actually do? Their main game is mining something called coking coal. Now, you might be wondering, what's coking coal? It's super simple. It's the critical, absolutely essential ingredient for making steel. Think about it. No coking coal, no steel. It's that basic. And get this, BCCL is sitting on a mountain of it. We're talking over 7,900 million tons in reserves. That's one of the biggest stashes in the entire country.
Now, they do have a few other things in their product lineup. Non-coking coal, washed coal. But let's be real, coking coal is the star of the show. It is their bread and butter, the absolute core of their business. And who's supposed to buy it? Well, steel manufacturers and power producers.
Okay, so if coking coal is for steel, it's pretty logical to assume their biggest customers would be steel companies, right? Makes sense. But this is exactly where things start to get a little weird. Let's actually look at the numbers. And just as we thought, look at this. Coking coal is bringing in a whopping 75% of their revenue. It completely dominates. So, yeah, this confirms it. They are a coking coal company, first and foremost. So far, so good. Everything seems perfectly normal.
And here it is. Here's the big twist. The steel industry, the one that actually needs coking coal, makes up a tiny, tiny 2.2% of their customers. So who's buying all this coal? It's the power industry, almost 78%. That's a landslide. This right here is the central puzzle we need to solve.
So let's just lay it out bare. Why is a company that specializes in coal for steel selling almost all of it to power plants? What is going on? Well, the answer comes down to one single word: quality. It turns out that not all of their coking coal is quite up to snuff for making high-grade steel. But for power plants, it works perfectly fine. Let me explain.
All right, let's dive into what I'm calling the coking coal conundrum. And the whole thing kicks off with a basic problem with the type of coal we find here in India.
So here's the deal. Indian coking coal, and that includes the stuff from BCCL, has a really high ash content. We're talking 18 to 35%. Now, what does that mean? It means if you try to make steel using only this coal, the steel you get is, well, it's weak, brittle. It's just not strong enough for the kind of high-quality steel that's in demand.
So how did the steel makers solve this problem? They've got a pretty smart workaround, a kind of blending solution. Here's how it works. Step 1. They import the good stuff, high-quality, low-ash coal. But that's super expensive. So step 2, and this is the crucial part, they take that imported coal and they blend it with the cheaper, washed Indian coking coal from BCCL. Usually it's about 30 to 40% Indian coal. And it's that mix, that final blend, that they use to make high-strength steel.
And there you have it. That's the big secret. What looks like a weakness, the fact that their coal isn't perfect, is actually what makes BCCL so incredibly important. They provide the essential domestic ingredient that allows our steel industry to avoid being completely 100% reliant on expensive imported coal. They are a strategic asset.
Okay, so now we get the business model. It's unique, it's strategic, but is it profitable? Let's check the books and see if the numbers are as interesting as the story. First up, let's look at revenue. It's grown at a CAGR, that's compound annual growth rate, of 5.2%. Now, that's not going to blow your socks off, but it's solid, steady growth. It shows they're consistently selling more year after year.
Okay, but hold on, because this is where it gets really impressive. Their operating profit, or EBITDA, has been growing at an incredible 62.6% a year. That is huge. This tells us they're not just selling more, they're getting way, way better at making money from what they sell. Super efficient.
And that awesome efficiency flows right down to the bottom line. Their net profit, the actual cash left after everything's paid, has grown at a really strong 36.6% annually. So from a financial perspective, this company looks like a rock.
But, there's always a but, right? A great growth story is only one side of the coin. Every single investment has risks, so now we have to do our homework and look at the red flags. What's hiding in the fine print of the IPO?
All right, so there are a few big ones to watch out for. First, concentration risk. Geographically, all their mines are just in 2 states. Product-wise, they're super dependent on coking coal. That's 75% of their revenue. And customer-wise, their top 10 customers make up almost 89% of their sales. That's a lot of eggs in very few baskets. And, of course, the big one. Coal isn't going to last forever. It's a finite resource.
And then there's this number. Brace yourself. Almost 3,600 crore rupees. And what is that? It's something called contingent liabilities. Basically, it's a huge pile of potential future costs from things like lawsuits, money that they might have to pay out, but it isn't officially on their books just yet.
Now, to give you some perspective on just how big that number is, think about this. That potential debt is 3 times their annual net profit, and it's double their profit before taxes. That is a massive shadow hanging over the company's finances. You just can't ignore a number like that.
So let's recap. We've got a strategically vital company, awesome growth, but also some pretty serious risks. The last piece of this puzzle is the price tag. Is the IPO valuation actually fair?
Okay, if we look at the PE ratio, that's the price to earnings ratio, a really common way to value a company. Something jumps right out. BCCL is coming in at a PE of 43. Compare that to its parent, Coal India, at just 8, or even its international competitors. BCCL is asking for a much, much higher price. Investors are being asked to pay a serious premium here.
So, let's get down to the nitty-gritty of the IPO. Crucially, this is a 100% offer for sale, or OFS. What that means is that all the money from the IPO is going to the current owner, the government, who is selling their shares. None of that cash is going back into BCCL to grow the business. The price is set between 21 and 23 rupees per share.
And so that all brings us back to the big question. On one hand, you have a company that is absolutely critical to India's industrial backbone, a real strategic asset. But on the other hand, you've got that sky-high valuation, some pretty concentrated risks, and a huge pile of potential liabilities. So is its vital role in the economy enough to make that price worth it? That, my friends, is the big question every potential investor has to answer.